Hey, what's happening, everybody? Welcome back. Our next topic is changes in accounting estimate. But before we do that, make sure you have your Red Bull and your coffee ready. Let's take a sip. And did you notice you are loved? That's right. You may not have known, but we love you. You're going to make us look good. You're going to pass this exam. I think I see a 99 in your future. That's right. I know, you're like, shut up, stupid. So here we go. Changes in accounting estimate. You ready? When you see changes in accounting estimate, I want you to think three things. Number one, when you change an estimate, that's not an error. Sometimes we have better information. So in good faith, we change the estimate. Since it's not an error, folks, you are not going to restate prior years. When you have a change in estimate, leave what you've already done in prior years alone. We don't need to restate that. We don't need to adjust beginning retained earnings net of tax. Don't do any of that. What we use instead is what we call a prospective approach. So what is a prospective approach? All righty. So that means we're probably going to use that new information not only in the current year, but assuming it affects future years, we'll use that new information in future years as well. So management has determined that, hey, we have new information. The estimate we used previously is no longer applicable going forward. It was the best information we had in prior years, but we got better information now. So, but what exactly does prospectively mean? That means, again, not only does it affect the way you calculate income from continuing operations this year, but assuming that change in estimate is going to affect us in future years as well, well, then you know what? That new information will affect probably not only your income statement, your balance sheet as well. Think about if you change, let's say, your estimate for bad debt expense. Alrighty, that'll affect your income statement, but it'll also affect the way you present and calculate your allowance for uncollectibles. So it'll affect both your income statement as well as your balance sheet more likely than not. And that income from continuing operations, remember, that could be an estimate related to your core business, the calculation of operating income, and or non-operating, okay? Now, when we have that change in estimate, the first thing you got to do is use the new estimate, implement it in the current year, and then future years, unless you have better information next year, right, you'll use that new estimate in current year and future years as well. As already mentioned, folks, we do not restate retained earnings. That's a common mistake. Change in estimate is not an error correction. Do not restate retained earnings. Now, should we disclose this? Well, anything that's material, you got to disclose. But right up front on the exam, if they tell you the change in estimate is not only going to affect the current years, but future years as well, then you should talk about that in the notes, okay? What new information did we get that we're going to change the useful life of this machine or whatever it may be? If it's simply, though, a change in an ordinary accounting estimate and it's not material, then you don't need to talk about it. You could, but you don't need to, okay? So certain things are changed on an annual basis, like, the allowance for uncollectibles. A lot of that is heavily dependent upon, how your customers are doing, right, financially, and whether or not the economy is doing well. So the credit markets really are going to determine whether people are more likely or less likely to be able to make their payments on time, etc. Alrighty, so assuming it's ordinary and it's not material, no, you don't need to disclose it, okay? Now, next issue. What are some common examples of changes in accounting estimates? You don't have to memorize this, but be familiar. As I've already mentioned, changing the useful life of an asset. We'll see that in a little bit. You might have an estimate for accruals for, the officers' salaries or bonuses, and then you get new information. Okay, so that's a change in estimate. Writing down obsolete inventory, right? How much you think is obsolete. Well, that may not be the same from one year to the next. Why? New information. How are economic conditions? The demand for your product, whatever it may be. Litigation. A lot of times you're relying upon estimates and then, we have better information. We're more likely to lose, less likely to lose, whatever. Settlement of litigation. The next one's the big one. A change in accounting principle, which we haven't discussed yet. As a general rule, when you see change in accounting principle or change in accounting estimate, you're going to think retrospective approach, which we'll see in the next video. But immediately when you see change in accounting principle, I want you to remember there's a general rule, retrospective, but then there are exceptions where even though it might be a change in accounting principle, we might say, hey, you know what, it's really inseparable from a change in estimate, or it's not practical to retrospectively change. So memorize this for me. You ready? Anytime we're going to LIFO, I know that's a change in a method of accounting for inventory, but when you go to LIFO, not from LIFO, to LIFO, what are we going to use? Prospective approach. Or you change your method of depreciation. I know that's an accounting principle. We're changing the method. Nonetheless, to LIFO or change your method for depreciation, you immediately stop and say, hey, that's an exception to the general rule. Even though that might be a change in accounting principle, we're going to treat that as though it's a change in estimate, and we're going to use a prospective approach. More to come on that in the next video. That's the cliffhanger to get you all excited. And then the last one is, we've covered already, discontinued operations. You know, impairment losses. You know what? You might reverse them. You know, there's a bidding war, or maybe you have to increase that impairment loss. But revisions to those types of estimates, you know, a change in estimate, don't restate prior years, prospective approach. Okay, excellent example. First thing you always want to do, legalize cheating. Start with your requirements. What do they want me to do with this information? Create a depreciation schedule for the life of this truck. Well, I look at my facts. Carlin Company buys a truck for $90,000. There's your cost. The truck is expected. Now, this is the original estimate. They thought the truck was going to last 10 years, okay? So that's your original useful life. During the third year, that means 2 years have elapsed already. We're not going to touch years 1 and 2. We're going to leave them alone. We're not going to restate. This is not a correction of an error. But sometime during year 3, management's determined, you know what? The truck's only going to last a total of 5 years, a total of 5. Stop right there. So we're going to change our estimate down from a 10-year total useful life to 5. Take that 5-year useful life total, the new estimate, and subtract from it the time elapsed. 2 years have gone by. Stop right there. What's your remaining useful life? 3 years. Step 1 is complete. Now I need to find the net book value as of the beginning of year 3. 2 years have gone by. How much depreciation has already been accumulated in years 1 and 2 using the original estimate of 10 years? So I take that $90,000 cost, there's no salvage value, divided by the original estimate of 10 years. So in years 1 and 2, we took depreciation of $9,000 year 1, $9,000 year 2. Accumulated depreciation, 9 plus 9, confidence building, $18,000, right? Your cost was 90 minus the accumulated depreciation as of the beginning of year 3, 18,000. What's our remaining book value that has to be spread out over 3 remaining years? Well, 90 minus 18, $72,000. That's our remaining net book value. Divide that by your remaining useful life of 3 years. What's our depreciation expense now going to be in years 3, 4, and 5? $24,000. So notice, we implemented the new estimate in year 3, and we'll use it in years 4 and 5. It not only affects the current year income from continuing operations, but future periods as well, assuming we don't change the estimate again. So what does that look like? Nice and pretty. Here's your schedule. Years 1 and 2 are okay. Years 1 and 2, we do not restate those prior years. That's step 1 with the change in estimate. Do not restate. Prospective approach. Now, year 3 is the year we have the new information. We use the new information in year 3 to get the 24, and we'll use it in years 4 and 5 as well. Okay, so $24,000. Would this be disclosed in the notes? Yeah, because not only does this change in estimate affect the current year, it's affecting future years as well. Now, I want you to notice something. Is this change in estimate going to affect my quality earnings such that it's being more conservative or aggressive? Anytime you change an estimate in a way that increases the expense and reduces the net income, that would be a conservative change in estimate. So instead of having a 10-year life with $9,000 of depreciation, we reduced it to a total of 5. So year 3, the current year in particular, instead of having $9,000 of depreciation, we almost have triple that, $24,000. So that means higher expense, lower net income. Relatively speaking, all other factors constant, change in estimate would be relatively conservative since you have a lower net income. I can barely get that out. I'm so excited. All righty, so that's change in estimate. Now in the next video, we're going to do change in accounting principle and change in entity. All right, see you then. All right, welcome back, my friends. Another sip of coffee before we get started. And yes, I still love you. Hope you're not cheating on me and going out with your friends. You know they really don't love you the way I do. And I know your boyfriend or girlfriend or significant other certainly doesn't love you the way I do. All right, changes in accounting principle or accounting entity. When you see that on the exam, what do you immediately think? General rule, retrospective approach. General rule. Now, anytime I emphasize a general rule, you know we're going to have exceptions. But change in accounting principle or change in entity, we think retrospective application, okay? Retrospective. Now, retrospective application, what does that mean? We're going to have to adjust beginning retained earnings net of tax. Anytime you're touching retained earnings, you always make the adjustment net of tax. And I'll keep emphasizing that. You don't want to make a silly mistake. Common wrong answer choices are going to have you adjust beginning retained earnings, but forget to multiply that adjustment by 1 minus the tax rate. You're not going to do that. Okay, so what is a change in accounting principle? Notice you're going to switch from one acceptable method of accounting to another acceptable method of accounting. Now, why am I emphasizing acceptable? Because anytime you do something you weren't supposed to do, you go from non-GAAP to GAAP, that's not a change in accounting principle, folks. That's a correction of an error because you're never supposed to use an unacceptable method of accounting, okay? So go from one acceptable method to another acceptable method. Hey, that's going to be a change in accounting principle. General rule, retrospective application. Now, you can't just change accounting principles from one year to the next without justification. Why? It makes the analyst's job very difficult when they have to do trend analysis. If one year you're LIFO, another year you're FIFO, if one year you use straight line, another year you would use accelerated, it makes it really difficult to compare the company to itself over time. So it's got to be justified, okay? So the rule of preferability. An accounting principle can only be changed if it's justified. So look, it might be required by GAAP. That's justification. Or management has determined that, you know what, the new principle is going to more fairly present the results of operation, okay? So it's got to be justified. What you can't do is what's called income smoothing. That's not allowed. So you can't look at your current year and say, oh my goodness, revenue's going down. Let's switch to methods of accounting that would have us record lower expenses, right? So let's say you're in a rising price environment. You'll see this when you get to inventory. And then the company says, well, we've been using LIFO, right? Current costs would be higher in an inflationary environment. Well, because revenues are going to get down, let's switch from LIFO to FIFO so lower revenue is offset by lower cost of goods sold. You can't do stuff like that, okay? It's got to be justified. Management's got to make the case that, hey, this is going to more fairly present our results of performance, okay? So no income smoothing. All righty, now, you've got to be able to calculate cumulative effect of that change in accounting principle. The problem with this is you haven't reviewed with us a lot of the rules for calculating the amounts that you'll see in future chapters. So you may have to do a little cheating here and there, and fight through the calculation of the number. Then you could revisit these later on as we cover those specific rules and accounting for whatever it may be, okay? So don't sweat the numbers right now. Understand the principle. All right, what if we have non-comparative financial statements? What does that mean? Let's just say we're only showing the current year. Let's say the current year is 2024. We are not showing years 2023, 2022. We're only showing the current year 2024. Then what you're going to do is when you change accounting principle, general rule, you're going to use the new method in the current year 2024. You'll use the new accounting principle and you will calculate for me, number one, what earnings would have been if the new method had always been used. Then what you're going to do is adjust beginning retained earnings for the difference between what earnings were under the old method versus what earnings would have been under the new method. And then we will adjust beginning retained earnings for 2024. The beginning balance, you will adjust. And that will now take our retained earnings from what it was using the old method to what it is now had we always used the new method. All right, you'll see it's not that big of a deal. And that's what we'll do if non-comparative financial statements are being shown. You only got the current year, adjust the beginning retained earnings for that current year cumulatively. What if, on the other hand, comparative financial statements are being presented? So let's say the current year is 2024, but we're also showing our income statement for 2023 and 2022. This is what we're going to do. Since we're showing 2022, 2023, 2024, you're going to use the new accounting principle to calculate the income for the years you're showing, 2022, 2023, 2024. Easy. Use the new accounting principle for all years you're showing. And what else are you going to do? All right. we're going to now have to adjust beginning retained earnings for the very first period presented. In my example, that would be 2022. Adjust beginning retained earnings for 2022 as if the new accounting principle had always been used. So beginning retained earnings 2022, what is it using the old method? What would it have been had we always used the new method? We'll adjust beginning retained earnings net of tax, okay? And don't forget, whenever you adjust that beginning retained earnings, we always do it times 1 minus the tax rate, okay? And in my example, we would adjust beginning retained earnings for the earliest year presented, 2022. Okay, here's an excellent example. Again, start with your requirements. Calculate the cumulative effect of the net income tax change in the accounting principle. And you're like, oh man, we haven't reviewed these rules. Don't sweat it. We'll give you the number, okay? It's about the presentation, how we're going to adjust. So follow with me. January 1, year 5, Harbor Company decided to switch to the weighted average method. Stop right there. That is my new accounting principle, okay? So we're switching to weighted average. So the general rule is going to apply. We're going to use a retrospective approach, okay? And I'll talk about the exceptions in a minute. So we're switching to the new method, weighted average. The old method happened to be FIFO, okay? So prior to year 5, they always use FIFO. Tax rate circle 30%. All right, now we're giving you the numbers. Earnings before tax prior to year 5 was $600,000 using the old method, FIFO. Had we always used the new method, weighted average, what would our earnings before tax have been? $800,000. Confidence building. What's the cumulative effect of that change in accounting principle? Well, 800 minus 600. Hey, had we always used weighted average, our earnings before tax would have been higher by what amount? $200,000. Now, these are non-comparative. This is a non-comparative example because we're only showing year 5. So we have to adjust beginning retained earnings for the earliest year presented, which is only 2005. So we're going to adjust our beginning retained earnings. How? Net of tax. So step number 1, we've already determined we're going to use the new method, weighted average in year 5. Now we're going to adjust beginning retained earnings for year 5, 200,000, but times 1 minus the tax rate. We're not going to choose 200,000. That's the most common wrong answer choice. Multiply that by 1 minus the tax rate. What's the cumulative effect of that change? Net of tax, 140,000. We'll adjust beginning retained earnings by 140,000. Now, is retained earnings going to go up or down? Had we always used the new method, earnings would have been 800 pre-tax rather than 600. So beginning retained earnings is going to go up by not 200,000, but up by 140. And then again, we use the weighted average method in year 5 to calculate our cost of goods sold for the only year presented, which is year 5. Piece of cake. What does that look like now? Nice and pretty. The cumulative effect of that change prior to year 5, beginning of year 5, 200,000 gross. Multiply that by 30%. The tax effects are 60. We will adjust beginning retained earnings net of tax by 140. Okay, so the 140 would be an adjustment to the earliest year presented, and since it's non-comparative, we're only showing year 5, we would obviously have to adjust beginning retained earnings for year 5. Okay, now very important. Changes in accounting principle, general rule, what do you think? Retrospective approach, okay? So let's say we have comparative financial statements, 2022, 2023, 2024. We're going to adjust beginning retained earnings for which year? For the earliest year presented. And in my example, that would be the beginning of 2022. We would adjust beginning retained earnings net of tax. That's that retrospective application. But we mentioned in the prior video 2 major exceptions that even though it's a change in accounting principle, we are not going to account for it retrospectively. We're going to account for it prospectively. What are the 2 major exceptions that even though it's a change in accounting principle, okay, change in method, we're going to use the prospective approach as if it's a change in estimate when we're going to LIFO, not from LIFO, not to FIFO, but to LIFO. When you're going to LIFO, prospective approach, hey, it's just not practical to go back and calculate the cumulative effect of the change. So just go ahead and account for that using the new method LIFO in the current year and future years. Do not restate prior years. And the other one is when we have a change in depreciation method. Even though that's a change in accounting principle, it's also kind of like a change in estimate, spreading out that cost over the periods benefited, whatever. When you change your method of depreciation, what approach are we going to use? Prospective. to LIFO or change our method in depreciation, we're going to account for that prospectively. Use the new method in the current year and future periods, okay? Do not restate beginning retained earnings net of tax. All right, so application of the general rule. All right, so if we're showing years 2024, 2023, 2022, the general rule, we would adjust beginning retained earnings for the earliest year presented, and in my example, that's 2022. Then use the new accounting principle for the financial statements you're actually showing me. 2022, use the new method, 2023, as well as 2024. Piece of cake. Woo! All right, that's change in accounting principle. You think retrospective general rule, except when you go when? To LIFO or change your method of depreciation. The other time I want you to think of retrospective application, adjust beginning retained earnings net of tax, a change in accounting entity. Okay, when the entity that's being reported on has changed composition, so they're consolidating, all right? So when you have control, you'll learn about this in another class. Generally, that's evidenced by owning more than 50% of the voting stock, but there's other ways you might have control, special purpose, variable interest entities, whatever. When you have control and you consolidate, the composition of the companies within that consolidated company could change. Now, if they change, you immediately think retrospective application. So look for a merger, an acquisition, a divestiture. Retrospective application when we have a change in the composition of the entities that are part of those consolidated financial statements. So let's say the change occurs in the current year. Again, comparative financial statements. Let's say it's 2024 and they have a divestiture, a merger or acquisition. The consolidated group is changing. So if a change occurs in the current year, 2024, then all previous financial statements that are being presented in the comparison have to be adjusted as well. They've got to be restated as if this new consolidated group existed in the prior years that are being presented as well. So we have an acquisition in 2024. We have a new entity 2024. It'll definitely be part of the consolidation for 2024. But because you're showing me years 2023 and 2022, we want to compare apples to apples. It's no longer ABC, it's now ABCD. So what we want to do is for years 2023 and 2022, even though we didn't have Company D, we're going to retrospectively adjust for that acquisition as if Company D was part of that consolidated group in 2023 and 2022. This way we have a valid apples to apples comparison, okay? And full disclosure, you bet. Yes, we are going to disclose this. We need to explain what's changed, who came in, who went out, whatever it is, okay? So full disclosure, you bet. Woo! So we've gone through change in estimate. You think prospective approach, change in accounting principle, change in entity. You think retrospective unless it's to LIFO or change in method of depreciation, then it's prospective. The only thing we haven't talked about is correcting an error, and that's the next video for you guys, all right? So I'll see you in a little bit. All right, what's happening, everybody? Our next topic, error correction. Not correcting the error of not studying hard enough such that you failed the exam and now you got to retake it. No, we're going to correct that error before it even happens. You're not going to make that error. So error correction, we're going to call this a prior period adjustment. And folks, when you see an error on the exam, you think PPA, prior period adjustment, and we got to restate those financials. So let's take a look at the different scenarios. Error corrections, first of all, not changes in accounting principle, folks. An error correction comes because we have an error in the recognition or maybe measurement or presentation or disclosure. Maybe it's a mathematical mistake. Maybe we were mistaken in the way we applied US GAAP. Maybe we had an oversight or misuse of the facts. Any of those are going to be an error correction. You think prior period adjustment. We got to restate those financials, okay? Now, if you go from non-GAAP to GAAP, that is an error. You should have never been non-GAAP. Read carefully. When you go from GAAP to GAAP, that is a legitimate change in accounting principle. But when you go from non-GAAP to GAAP, that's a correction of an error. So, for example, you go from cash basis to accrual. That's not changing accounting principle. You should have never been cash basis. So because that's non-GAAP to GAAP, you think error correction, not PDA, PPA, prior period adjustment. All right, now how do we present this? How do we fix this error?
Well, the first thing is, let's pretend we're showing comparative financial statements. Let's say we're showing years 2022, 2023, and 2024. Those are in the financial statements, okay? Those 3 years side by side. If the error happened in one of the years where we're showing the financial statements, very simple. Simply correct the error in that financial statement. So if we're showing 2022, 2023, 2024, if the error happened in 2023, well, then just fix that income statement and balance sheet, and we're all done. Now, what if the error happened in a year that we are not presenting? So we're presenting comparative financials for 22, 23, 24, but the error happened a long time ago. Let's say it happened back in 2019, and we're not presenting that year. Well, then the only way to fix this is to adjust the beginning retained earnings for the earliest year presented. So the error happened in 2019. We'll have to fix this by adjusting the beginning retained earnings for 2022. And whenever you adjust retained earnings, we'll see it's net of tax. Okay, what if comparative financial statements are not presented? What if we're just showing 2024? That's it. Well, then the only way to fix that error, if it happened in any other year, 23, 22, 21, whenever, the only way to fix that is to adjust the beginning retained earnings for that 1 year you're presenting. So we'd have to adjust beginning retained earnings for the only year we're showing, 2024. And again, when you adjust beginning retained earnings, how do we always do it? Net of tax. Okay, now we have an excellent example of accounting changes and an error correction. Let's pretend we're only showing 1 year, year 4. We'll make it 2024. Okay, that's the only year they're presenting financial statements for. So here are our facts. And by the way, the tax rate is 40%. Okay, in year 4, Jordan Manufacturing discovered that their depreciation expense was incorrectly calculated. Stop right there. Whenever you have a mathematical error, you think, well, hey, that's an error correction, PPA, prior period adjustment. We're going to adjust beginning retained earnings net of tax. Well, they made this error back in 2021 and 2022. We're not showing either one of those years. So the only way to fix the problem is to adjust beginning retained earnings for the year we're showing, 2024. A total of $4.5 million of depreciation expense was never recorded. Folks, that means our earnings before tax is overstated by $4.5 million. If they didn't record that expense, then our net income, our earnings before tax, is overstated by $4.5 million. So we've got to adjust beginning retained earnings downwards. $4.5 million, though, is the gross amount. We have to adjust beginning retained earnings net of tax. So what do? Take the $4.5 million, multiply it by 1 minus the tax rate of 40%. So folks, that means our net income would have been overstated by $2.7 million net of tax. So then to fix that, we have to adjust our beginning retained earnings, $2.7 million net of tax, but downward. You don't record that expense, that overstates our net income. We adjust our beginning retained earnings, net of tax, okay? So take the $4.5 million expense that wasn't recorded. Earnings before tax was overstated by $4.5 million, meaning net income was overstated by $2.7 million net of tax. So adjust beginning retained earnings downward. Okay, now the other issue we have is at the beginning of year 4, in 2024, the company decides to change inventory methods from LIFO to FIFO. Now that's a change in accounting principle, all right? That's a change in method, all right? So how are we going to adjust for this? Retrospectively. We'll use the new method FIFO in the current year, 2024, and then we'll adjust beginning retained earnings for 2024 for the cumulative change in that accounting principle, okay? So retrospective. So now let's see what they tell us. The following information details the pre-tax income under LIFO, the old method, and then FIFO, the new method. So folks, pre-tax income, let's do it year by year. Year 1, 2001, the LIFO income was $3 million. Had they been FIFO, the income would have been $3,750,000. So folks, the income, $3,750,000, new method versus $3 million old method. Well, we're adjusting for this retrospectively. So folks, that's a $750,000 adjustment upwards, okay? So earnings before tax, year 1 would go up by $750,000. What about year 2? Okay, under the old method LIFO, in year 2, they've got $3.4 million earnings before tax. Had they been FIFO, it would have been $5.5 million. So 5.5 million minus 3.4 million, the adjustment for 2022, we have to increase earnings before tax by 2.1 million. Year 3, the old method LIFO, they're showing income of 4.1 million. Had we been FIFO, the earnings would have been 6.25, 6,250,000. So 6,250,000, new method minus 4,000,001, old method, we would have to adjust earnings before tax upwards by 2,150,000. So cumulatively, 2021, 750, 2022, 2,000,001, 2023, 2,150,000. Add it all up. The cumulative change is going to be $5 million. But folks, that's pre-tax. Remember, we always adjust retained earnings, net of tax. So 5 million times 1 minus the tax rate, we would adjust beginning retained earnings net of tax by $3 million. Okay, upward. Now, just be mindful, folks. We went from LIFO to FIFO. If in this question we had gone to LIFO from FIFO, well, when you go to LIFO, that's a change in accounting method. But remember, whenever you go to LIFO, we would use a prospective approach. Just use LIFO in the current year and going forward. But since we're going to FIFO, retrospective application, we got to find the cumulative effect of that change in accounting principle. Pre-tax 5 million, 3 million after tax. Excellent. Okay, so now a little detail, nice and pretty for you. So the depreciation error, correction of an error, prior period adjustment, restate beginning retained earnings net of tax, and then the change in accounting principle, because we're going to FIFO, that's retrospective, cumulative change, adjust beginning with retained earnings net of tax. And remember, use the new method FIFO in 2024, and then calculate, like we did, the cumulative effect of that change in accounting principle. So now the numbers, once again, for the correction of the error. We did not record depreciation of $4.5 million, so our pre-tax earnings were overstated by $4.5 million. But we got to convert that to after tax, so we multiply it by 1 minus the tax rate. We got to adjust beginning retained earnings downward by $2.7 million net of tax. The second issue, change in accounting principle, the cumulative effect, we're going to FIFO. So the cumulative effect for all 3 years, 750, 2,000,001, 2,150,000. Before tax, we would increase earnings before tax by 5 million, but net of tax, we multiply that by 1 minus the tax rate, retained earnings would go up by 3 million net of tax. So the net effect of both of those adjustments to beginning retained earnings would be a plus 300,000. 2,000,007 downwards for not recording the depreciation, the net of tax adjustment, 2,000,007 down, and then switching to FIFO from LIFO. Well, then we go up by $3 million net of tax. The net effect is adjust beginning retained earnings. The net change would be $300,000 upward. Okay, so excellent example illustrating that change in accounting method. Okay, make sure you read carefully. You're going to LIFO or from LIFO. All right, in this example, we were going from LIFO to FIFO. So we do the cumulative effect. Remember, whenever you see a switch from non-GAAP to GAAP, that is a correction of an error. You should never be non-GAAP, right? So that's not a change in accounting principle. We're not going to do that retrospect. We're going to do a prior period adjustment, correction of an error. All righty. Okay, good stuff there, guys. We'll see you in the next one. Good luck studying.